Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business. What it does, how it makes money, and what makes it competitively distinct.
Exxon Mobil is the largest publicly traded oil and gas company in the United States, a fully integrated energy giant spanning upstream exploration and production, downstream refining, chemicals, and specialty products.
Its roots trace back to 1870 and John D. Rockefeller's Standard Oil. After the famous antitrust breakup in 1911, successor companies eventually recombined in the landmark 1999 Exxon Mobil merger, reuniting two of Standard Oil's largest heirs.
The business runs on four core segments. Upstream production is the earnings engine. Energy products covers refining and fuels. Chemical products handles polymers and petrochemicals. And specialty products covers lubricants and basis stocks.
Upstream generates roughly 70% of total earnings. That's where ExxonMobil's two biggest competitive advantages live: the Guyana deepwater operation and the dramatically expanded Permian Basin position.
The Stabroek Block offshore Guyana is one of the most significant oil discoveries of the last 3 decades. Production costs are extremely low, and the multi-phase resource base stretches well into the 2030s and beyond.
Then came the 2024 Pioneer Natural Resources acquisition, a $60 billion deal that made ExxonMobil the dominant Permian operator, adding decades of low break-even drilling inventory and substantial free cash flow capacity.
On the chemical side, ExxonMobil converts refinery byproducts into polyethylene, polypropylene, and specialty polymers. That integration transforms a potential cost center into a durable, separate earnings contributor across the cycle.
The company is also one of the longest-running dividend growers in the S&P 500, over 40 consecutive annual increases, including through the 2020 downturn when most large energy peers either cut or froze their payouts.
Underpinning that dividend resilience is a structural cost savings program targeting over $9 billion in reductions through 2027, keeping free cash flow robust even during periods of weaker commodity pricing.
Competitively, ExxonMobil sits alongside Chevron, Shell, and Total Energies in the supermajor tier. Its differentiation comes from Guyana resource quality, Permian-scale post-Pioneer, and the depth of its chemical integration.
CEO Darren Woods has led the company since 2017. He's been the architect of both the Pioneer acquisition and the multi-year structural cost reduction program that has fundamentally repositioned ExxonMobil's long-run cost curve.
The global footprint spans more than 60 countries, with 21 refineries and operations stretching from deepwater drilling in South America to carbon capture research projects on the United States Gulf Coast.
ExxonMobil is best understood as a capital allocation and cost discipline story, not a hypergrowth story. The goal is maximizing risk-adjusted returns from world-class resources across a wide range of commodity price environments.
The key threads to follow: the Pioneer integration timeline, Guyana production phase ramp, chemical margin through the cycle, and the pace of structural cost savings delivery against that $9 billion target.
That's the company chapter for ExxonMobil. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
ExxonMobil just delivered an adjusted earnings beat that Wall Street needed to see. Q1 2026, adjusted EPS of $1.16 versus estimates of $1.00, a 16% beat. Revenue hit $83.2 billion. Record Guyana production and Golden Pass LNG progress were the headline drivers. This is Charged Alpha. Let's break it down.
ExxonMobil is the largest publicly traded oil and gas company in the United States, market cap of $641.5 billion. The business spans upstream oil and gas production, refining, and petrochemicals through its product solutions segment and low-carbon solutions for the energy transition. The integration across the value chain is the enduring competitive advantage.
The headline numbers were strong on an adjusted basis. GAAP EPS came in below consensus due to a $4 billion hedging charge tied to geopolitical price movements in the Middle East. Stripping that out, underlying operations delivered across Guyana, Permian, and refining segments. Investors who focus on adjusted results will view this as a clean beat.
Let's walk the income statement. Total revenue was $83.2 billion for the quarter. Net income on a GAAP basis was weighed by the hedging charge, but adjusted earnings of approximately $7.9 billion reflect the underlying business strength. Revenue growth of 2.5% year-over-year is modest. This is a commodity business, and the macro environment held Brent crude in the $75 to $85 range during Q1.
On margins, gross margin held at 31%. Operating margin of approximately 11% reflects the midstream and refining cost structure layered on top of upstream production economics. Net margin came in at 5% on a GAAP basis, materially higher on an adjusted basis when the hedging charge is excluded.
Cash generation remains the crown jewel. Operating cash flow for the trailing 12 months is $15.9 billion. Free cash flow over the same period is $23.6 billion, a remarkable figure that funds the dividend, buybacks, and growth CapEx simultaneously. Cash on hand stands at $8.4 billion against total debt of $41 billion, a net debt of $32.6 billion. That management is comfortable sustaining given the FCF trajectory.
The balance sheet total equity is $266.6 billion, a fortress. Exxon's capital allocation framework targets $15 to $20 billion in annual buybacks alongside the dividend, which carries a 2.7% yield and has grown for 42 consecutive years. For income investors, XOM checks the box on both yield and growth.
Guidance for the rest of 2026 points to continued Guyana ramp and Golden Pass LNG commissioning in the second half. Management expects Guyana to hit 1.3 million barrels per day by year-end, a step-up that flows directly through to high-margin upstream earnings. Golden Pass Train 1 adds roughly 5% to U.S. LNG export capacity when operational.
Wall Street's view on Exxon is split between bulls and cautious holders. The consensus breakdown is 11 buy ratings, 13 holds, and 1 sell. The average price target sits at $153.54, barely above the current price of $150.50, implying only 1.3% upside. That tells you the question is less about near-term upside and more about long-term dividend compounding.
The valuation math. XOM trades at approximately 24 times trailing earnings and 17.8 times forward 2026 estimates. EV to EBITDA is 8.4 and price to book is 1.7. These are not cheap multiples for an integrated oil major, but they reflect Exxon's balance sheet quality, FCF durability, and the scarcity premium investors assign to the dividend.
Bulls on Exxon frame it as an infrastructure and yield compounder. Morgan Stanley called it a best-in-class capital allocator with the most visible FCF growth in the majors. Barclays maintained overweight, citing Guyana's low-cost production profile as a structural margin advantage versus Permian shale peers. The Golden Pass addition to the LNG portfolio is the optionality play.
The cautious voices focus on commodity dependence. Brent at or below $70 compresses margins meaningfully. The Middle East hedging charge in Q1 is a reminder that geopolitical exposure is a real earnings risk. Some bears also argue the 24 times PE is pricing in a commodity cycle peak rather than a trough, limiting upside from current levels.
Beta is 0.29, one of the lowest in the large-cap energy universe. That defensiveness is partly why 13 analysts rate it hold rather than buy. The stock behaves more like a bond proxy than a cyclical energy play. Forward EPS for 2026 is pegged at 8.54, which would put the stock at roughly 17.8 times on next year earnings.
The bull case rests on 3 pillars. First, Guyana. The Stabroek Block is one of the highest returning oil projects on the planet, break-even below $40 per barrel, and Exxon operates it. Ramping to 1.3 million barrels per day by year-end delivers earnings and cash flow growth independent of oil price direction.
Second, Golden Pass LNG. When Train 1 comes online in the second half of 2026, Exxon gains a direct LNG export position at a time when European demand for non-Russian natural gas remains structurally elevated. The project was delayed but is now approaching commissioning, removing a multi-year overhang from the stock.
Third, capital returns compounding. 42 consecutive years of dividend growth signals management's commitment to the yield. The annual buyback program of $15 to $20 billion at a market cap of $641 billion represents roughly 2 to 3% annual float reduction. Combined with the dividend, total shareholder return potential runs 5 to 7% annually before any capital appreciation.
The bear case starts with the commodity cycle. Integrated majors are ultimately price takers, and a Brent collapse to the mid-60s would compress cash flow and force difficult capital allocation choices between buybacks, dividends, and growth capex. The hedging losses in Q1 are a preview of what geopolitical shocks can do to reported earnings.
Second, energy transition risk. The IEA projects oil demand peaking within the decade. While Exxon's low-carbon solutions division is growing, it represents a small fraction of revenue. If the transition accelerates, the stranded asset risk on upstream reserves becomes a meaningful valuation headwind over a 5 to 10-year horizon.
Third, upstream execution. Guyana and Golden Pass are both in critical construction and ramp phases. Project delays, cost overruns, or sovereign risk complications in Guyana could disappoint the production growth narrative that is central to the bull thesis. Exxon has executed well historically, but the stakes are high.
The competitive landscape in integrated oil is led by Exxon and Chevron domestically. ConocoPhillips, COP, focuses purely on upstream and trades at a higher growth premium. Marathon Petroleum, MPC, is the refining specialist. Phillips 66, PSX, bridges midstream and chemicals. Exxon's full value chain integration is the widest moat in the group.
Versus Chevron, Exxon trades at a slight premium on PE, but offers a comparable dividend yield. CVX carries the Hess integration risk, but benefits from lower upstream costs in certain basins. ExxonMobil's Guyana position and the Pioneer acquisition, finalized in 2024, give it the deepest inventory of high-return drilling locations.
Versus COP, Exxon offers more income and less growth. COP is the pure-play upstream compounder for investors who want leverage to oil price recovery. Exxon is for investors who want commodity exposure with a dividend moat and balance sheet safety net. The choice between the two depends on income needs and risk tolerance.
Options activity around the Q1 print was modestly bullish. Put-call ratio of 0.78 reflects elevated call volume as investors position for the earnings beat. Oil price volatility is keeping protective puts bid. The options market is pricing higher than historical volatility on XOM, reflecting macro uncertainty more than company-specific risk.
On insider activity, the picture is quiet. Minimal insider trading in Q1, which management positions as a reflection of confidence rather than concern. The board's decision to maintain the dividend growth trajectory is the most visible signal of internal conviction. Institutional ownership is broad. Top holders include Vanguard, BlackRock, and State Street, each owning 5 to 8% of the float.
Bottom line on ExxonMobil, this is a structural compounder for patient income investors, not a near-term trading vehicle. The 16% adjusted EPS beat validates the Guyana and Golden Pass thesis. The hedging charge is noise. The dividend is safe. The buyback is accretive. For long-only investors with a 3 to 5 year horizon, XOM at 17.8 times forward earnings is a reasonable entry.
For active investors, the risk-reward is more balanced. The upside to the consensus target is thin, 1%. The downside from a commodity correction is real. Exxon earns its place in an income-oriented or defensive portfolio, but does not screen as the highest return idea in the energy sector heading into the back half of 2026.
Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.